Hi, everyone. Welcome to the webinar today. So happy to have you with us. We have an exciting topic to start off the year with in regard to advanced tax planning and tax strategies. And so we've brought on with us an expert to discuss what are some of the strategies you can use in your real estate journey. Before we dive into that, though, I did want to just make a few announcements. As you all are coming in, if you want to put in the chat where you're coming in from and who you are, we'd love to say hi to you. So please put your info in the chat or just give us a hello in there if you'd like. Also, too, just so everyone knows, we are recording the full webinar today, and we will be sending the recording to everyone tomorrow, as well as the PowerPoint slides. So you'll have plenty of time to review this, share it with a friend if you want, and hopefully, if you have any questions, we'll get them answered on this webinar. We will have some time for Q&A throughout and after the webinar. So if you want to put your questions in the Q&A box, not the chat, that helps us to keep ourselves organized here. So Q&A box, you should see that at the top or bottom of your screen. And then if you put it in there, we'll go in the order that they are plugged in or in the order that it makes sense with the presentation. And then if we don't get to your questions or you think of something after, we are going to make our speakers' contact information available to you in that follow-up email tomorrow. So be sure to take a look there. And I do want to introduce our speaker. This is Michael's first time speaking here at AAOA. He is, however, not a newbie when it comes to speaking. He is a regular speaker, director, and head of private wealth solutions at Origin Investments. And he basically oversees a lot of the strategies and develops partnerships to help his clients and the clients of Origin Investments and their platform. And so, with all that said, Michael, I'll have you start sharing your slides so that we can get the presentation going from here. And then for those of you who didn't hear me when I started, we are doing the recording. So be sure to look out to your email tomorrow. I know that's a common question we get. So Michael, thank you again for coming to speak to the group. I'll hand it off to you to get started.
Yeah, well, thanks so much, Alexandra. I really appreciate that warm introduction and the opportunity to speak with everybody here. I do speak quite a bit. I go to conferences for apartment owners from time to time, and we're a little bit different. The booth that you come up to, and I always tell people all of these booths up and down the rows at the conference, they are to help you solve problems that pertain to landlords, whether you need your appliances fixed or insurance or legal services. Everybody there is to help you solve problems. What we do at Origin is we help you completely eliminate and outsource all of those problems. So what we're going to be talking about today is 1031 exchange strategies that are sort of turnkey, that help you exchange out of your highly appreciated real estate and exchange up into institutional passive real estate and spend your time doing what you want to do instead of managing the portfolio. We do have an active sort of Q&A button. There's a lot of topics we're going to go through here. Some of it is technical, on like how a 1031 exchange works, matching debt and equity. Um, I do these presentations for CPAs and attorneys, and we really dig in deep. This is pretty surface level. There's a lot to cover here. So, as Alexandra mentioned, I think if you have a specific case or if there's something that you want to talk about here, you could certainly put it in the Q&A and we will get to your questions. But obviously, that's what we're here for. If you want to set up an individual call and talk about your specific case, we're happy to do that as well. Before we jump into it, I think it'd be helpful to maybe just take a look at the audience here and sort of what brought you here. So we've got four polls throughout this entire thing. So I noticed Alexander just put that up on the screen. So thank you for doing that. So what brought you here today? I'm basically planning to sell all an investment property and I want to understand my deferral options. Or I'm just here for information. I just want to learn a little bit. So take a look at those answers. If you don't mind, I'll give you another 10, 20 seconds to fill that out and we'll kind of go from there.
Yeah, it looks like we're almost at
Okay.
half of
I'm guessing everybody's
participation. So I'll go ahead and end the poll real quick, last minute, put in your response, and then let's look at the results here.
awesome. That's great. That's super helpful for us to kind of know why people are here and what brought you to the presentation. So really appreciate you taking the time to fill that out. So I think before we get going, it might be helpful to sort of understand who Origin Investments is and what we do. We're not necessarily a household name. Origin is a real estate investment manager based out of Chicago. We started as a family office. Our two founders were traders here at the Mercantile Exchange in the pits in Chicago and did quite well for themselves. And so, as they moved out of the trading business in the late 90s, it was sort of like, where do we invest our capital to preserve and protect and grow our wealth for the very long term? And they chose real estate. So, you had sort of two non-real estate guys that started this business investing their own capital. And so they really look at it from a data-driven approach, from a different perspective, all about risk mitigation and how do we optimize our total returns. And because of that, we've been a top quartile manager every year of our existence since 2007. So our performance has been pretty stellar. We only invest in multifamily. So we don't invest in office buildings. We don't buy shopping centers or data centers or things like that. That's for a reason. I've got some slides on multifamily, but the data tells us it's the best risk adjusted return that you can get in the commercial real estate sector. So we were started back in '07 by our two founders. We have, just about 4 billion of assets under management. And we work directly with individual investors. So we have almost 5,000 individual investors throughout those years. We've got a full investor servicing team, investor relations team that works with those investors every single day. And then you'll also see RIA partners. This would be wealth management firms that we work with across the country. We have over 120 wealth management firms that we're working with today as well. So, given that we only invest in multifamily, we do have a few strategies for people that just want an allocation. We've got a private credit strategy that makes loans to multifamily assets. On the private equity side, we've got Income Plus Fund, which is growth and appreciate income plus growth. We've got our Select Asset Fund, which is a ground up development fund. And then on the tax advantaged real estate side of things, which is what we're focused on today, we offer a turnkey 1031 solution for people that are rolling out of appreciated assets. So I kind of look at it as we've got our allocation strategies and sort of our event driven strategies all within that multifamily bucket. You can also see we invest kind of in high growth markets. These are our offices in Denver and Dallas, Nashville, Charlotte. We're opening another office in Miami in 2026. So we're based in Chicago. We obviously don't buy here. We want to buy where we think the rent is going to grow the best. My name is Michael O'Shea, as Alexandra gave me a brief introduction. I run the private wealth group at Origin, so I spend most of my time traveling around the country, meeting with investors, educating on these tax advantage solutions, and updating on sort of real estate capital markets. I've been doing 1031 exchanges for the past 18 years now, so I've sort of seen the good, the bad, and the ugly in this 1031 exchange DST space. And at Origin, we think we've built a better mousetrap, more cost effective, and much lower fees for you, the final investor there. So this is what we're going to be talking about today, a 1031 exchange, which, most of the people that I talk to today are familiar with a 1031 exchange. There was a time back in the day when most people didn't know what that was. They didn't know what a DST was, but that's sort of coming around. A 721 or UPREIT, and UPREIT is an umbrella partnership real estate investment trust. That's a little bit less known. In my opinion, it's going to become more and more commonplace as it's a really nice solution for investors out there. So we're going to be talking about both of those strategies today. And so before we jump into that, maybe just the second poll question to kind of see where everybody's baseline is. Pretty simple question. I've used 721s and 1031s before. I've never heard of this at all, or I'm somewhere in between.
Yeah, and I'm not sure if you actually saw the results of the last poll. Did you? I'm not sure if it's shared correctly. Um,
I did, yeah. I
oh,
saw
okay,
that one.
good, good,
Yeah.
good. I'm
Yep.
glad because this is going to be an interesting one to see as well. Like you said, so many people know about it, but I'm curious because of the topic, how many came here maybe not knowing as much about these strategies. So, um, we have, oh, nice. A little more than half of you have already participated. So I'll go ahead and share the results this time. All right, there we go. So most have heard of them, but haven't used them personally.
Good. This is really good feedback, and it kind of parlays into what we're actually going to talk about because there's a reason that most people have heard of this but not participated in it personally. And that's really because Section 1031 there's a lot of rules to it, and you have to do everything fast. So, in order to do a 1031 exchange yourself, while it is one of the best tax breaks that you can find, I mean, usually zero tax is done if you do it correctly. There's just a lot of rules you have to follow. So at Origin, what we've created is a turnkey solution that makes it so you could do a 1031 exchange in a day. A very, very simple way to do it. And I'll explain that down the road. So when we say a 1031 exchange, it's just section 1031 of the tax code. It basically says if you sell a piece of property that's held for investment purposes or used in a trade or business, and you exchange it for the same, then it's not seen as a sale and a new purchase by the IRS. It's seen as exchange of assets. Your cost basis rolls over, and it would be considered a tax-free exchange at the state, federal, and local level. So obviously very powerful. When we talk about taxes on 1031s, I'm sorry, on sale of real estate, everybody thinks about the long-term capital gains, and that's really important to think about. But there's also significant taxes that sometimes aren't factored in when people estimate the sale of their real estate. So you've got depreciation recapture tax. So depending on how long you've held the asset, that's actually taxed at 25%. Net investment income tax on anything over 250,000. And then of course, state income tax. You know, we have a lot of people on this call from California. We always have a lot of people on these calls from California because the state tax is approaching 14%. And so here's just a simple example of a property where you bought it for 600,000, you've depreciated it by 200, you sell it for 1.2 million. So typical example of what we see out there. And if you might estimate, oh, well, I owe 120,000 of capital gains taxes, it's actually a lot more than that when you sort of break it down line by line. And so this is a $300,000 tax liability. And if you do a 1031 exchange, like I mentioned before, you get to defer all the state, local, federal, the net investment income tax, etc. On our website, we actually have a calculator that's pretty powerful. So you can enter in there, what did I buy the property for? What state do I live in? How much have I depreciated it? And it would kick you out a summary that you could then share with your accountant. The nice thing about it, if you go to our website, here's a little QR code, but it's just origininvestments.com, and you can find our calculator. The nice thing about it is there's a little button on the bottom that says email this to me, and it'll create a one-page PDF with all of the facts about your sale and your estimated taxes. Because as you go through a 1031 journey, everybody's going to ask you those same questions over and over. What is your debt level? How much have you depreciated? What did you pay for it? All that type of stuff. And then I think we'll get one more poll and then we'll really get into the meat of the presentation here. So the question is, where are you at your, like, you joined us to learn about this. Do you have a property that's, being sold? Are you thinking about selling a property? I'm not considering a 1031 exchange. Just want to know if you've got a deal you're actually working on here. All right, good. Yeah, we've got about half the people that are looking to sell the property soon, so that's good. There's always, properties being sold out there, so really appreciate that feedback, and this should hopefully be helpful for you as you go through this journey. And we will take a break on polls. We have one at the end, but they're kind of front loaded here, so give you a little break on answering them. So when we talk about 1031 exchanges, everybody says to me like, "Oh, that's where you get 180 days to roll the proceeds of your sale." And that is true. From the time you sell your property, and the vernacular we use is your property you sell is called the relinquished property, and then you have 180 days to buy a replacement property. So there's another timeline in there that people sort of forget about, and that is this identification window. So you do get 180 days, but from the time you sell, you have 45 days to identify a replacement property. And in that 45 days, you can identify up to three replacement properties. You can go over three, but it gets a little tricky. We're not going to get into that level of detail today. But after the 45-day window is up, you can only close on one or all of those assets that you identified. So think about a simple example where you're going to buy your neighbor's property or something. And so you sell your property, you identify your neighbor's property within 45 days, and then you're out of the 45-day window, and then your neighbor, something happens. They decide they don't want to sell to you anymore or what have you. Now you've just blown your exchange. So this 45 days is very, very strict. You can only close on what you've identified. And so it really has to happen at light speed. If you sell on January 1st, you have until February 15th to identify these replacement properties. And so that's a really important part that sometimes people overlook. So now we'll talk about some of the other requirements. So I mentioned earlier that when reading about the 1031 description, that it has to be like kind to the real estate that you sell. That doesn't mean that if you sell a hotel, you have to roll the proceeds into a hotel. It just means that if you sell real property that's held for investment purposes, you have to buy the same. So you could sell a hotel and you could buy an apartment building. You could sell raw land that doesn't cash flow, and you could roll that into a cash flowing property. So the fact that it cash flows or the fact that it's a certain distinct operation inside doesn't matter. It just has to be considered real property that's held for investment purposes. So you can exchange any of these on the left-hand side for each other. You'll see two on the bottom that are ways that we can securitize our interests. One is a TIC, and then one is a Delaware statutory trust. So these are ways for people to have joint ownership of real estate and pool their capital together to buy a bigger property. We could theoretically do our 1031 exchanges through a TIC, but the problem with a tenant in common is all major decision rights have to be unanimous. And so then you're going into a deal with partners that you've never met and they have control over the property. So there's quite a few challenges with that. The structure that we use at Origin is a Delaware statutory trust. So this is a trust that owns property that allows up to 2,000 investors to come in, pool their capital together, and buy a more institutional piece of real estate that's professionally managed. You get a monthly paycheck and there's no real estate management responsibilities for you ever again. You get to retire. So that's what we'll talk about DSTs a little bit more in the future. Personal property used to qualify. The Tax Cuts and Jobs Act of 2017 sort of repealed that. So everything on the right does not count anymore. You can't do collectibles or art or personal property. If you own a partnership that owns real estate, you can't sell your partnership interest and 1031 exchange it. On the right-hand side, those would all qualify for qualified opportunity zones, which is also something we do at Origin. But for the purposes of a 1031 exchange, it's just everything on the left. The other side of it is that you have to use a qualified intermediary. So this is an escrow agent that's going to hold the cash for you during the 1031 exchange process. An easy way to think about it is if the sale proceeds ever hit your pocket, you've just blown your exchange. So this is a very, very important part of the process. You must use a qualified intermediary. And I talked about that 45-day identification window a couple slides ago, and that is who you do your identification with. So you see the taxpayer here on the bottom, and it's sort of like a triangle over their head. So you sell the relinquished property, the sale proceeds at closing get wired directly to the qualified intermediary. And then once you find the replacement property, on that second closing, the QI will actually wire those funds directly to that second closing. So you, as the taxpayer, have actually never touched those dollars. So QI is not only important that you work with a good, competent, qualified intermediary, but also that you get ahead of it. So when you go to closing, you got to have that QI account set up. If you don't know any qualified intermediaries, we know tons of really good ones. So you can feel free to reach out for referrals if you are working on an exchange. Real estate is usually kind of held in partnerships or LLCs. You've got multiple owners. So this comes up all the time. The way to think about this is just continuity of title. So when you do a 1031 exchange, the same seller has to be the same buyer on the replacement property. So just quick example here, I mentioned selling partnership interests a minute ago. So if you think of this example that we've got here on the screen, you've got ABC LLC that owns a property, and you've got members A, B, and C. So in a simple example, ABC LLC would sell the property and then would do a 1031 exchange, and A, B, and C would retain their membership and their manco, and everything would be the same before as after. It's just that the LLC would own a different property. What happens a lot is that A, B, and C don't all want to do the same things. Maybe some of them want to cash out. Maybe they want to own three different properties. The good news is there's ways that we can be flexible here. It's again, you just have to get in front of it. So let's say, for example, A wants to do a 1031 and B and C want to cash out. There's a lot of simple solutions. One, you can do a drop and swap. So you would basically drop out of the LLC and into a tick interest. So instead of owning an LLC, now A, B, and C all own a third of a property. And so when it sells and you get your third of proceeds, you could do whatever you want with it. You could do a 1031, you can keep it and pay taxes. So it sort of sets everybody on their own path. The challenge with a drop and swap is you usually have to do that pretty far ahead of time. So sometimes people are going to closing table and they say, well, let's just do a drop and swap. The IRS could look at that as a step transaction. So it's just important if you want to do a drop and swap, you do it well ahead of time. You could also do a partial exchange. So if it's $1 million property, you can put 667,000. You could use that to buy out B and C, and then put the other 333,000, put that into a qualified intermediary account, exchange that, and then A could continue to manage that LLC as the 100% owner. The final thing you could really do is what we offer, which is a 721 UPREIT, which we'll talk about in a second, where the ABC LLC can do an UPREIT into our diversified portfolio, and then you could simply retitle it for all the individual members who can then sell their shares down the road. So the point of this slide is if you are in this situation where it's a little bit more complex ownership structure, you just need to get ahead of it where we could talk about like ideas and solutions, but certainly being in an LLC or a partnership does not preclude you if everybody doesn't want to do the exchange. It just makes it more fun. All right, so now we get into some of the math where you have to replace debt, you have to replace equity, the purchase price matters. The last three of these rules all kind of rhyme with each other, and so I've just included them here, and I have a couple examples. But people get confused on this, where you have replaced mortgage debt, the purchase price matters. When you do a 1031 exchange, if you want to do it with 100% tax deferral, you just have to think of two things. Number one, I have to roll all of the proceeds. Whatever proceeds come to me, which is the sale price minus expenses, minus debt, whatever that dollar amount of proceeds that come to me, I have to reinvest all of it. And now remember, that's only if you don't want to pay taxes. If you want to keep some and pay taxes, you can do that. But if you want to pay zero taxes, you cannot keep any of the money. So that's number one. All the proceeds have to roll over. Number two, you have to buy the same amount of real estate. So if you sold $1 million property, you have to buy at least $1 million of replacement property. So sometimes this gets a little confusing and people are not sure how it works, but that's it. You have to roll over all your equity and you have to replace the full value of real estate you sold. If you do those two things, it should be a fully deferred exchange. So here's just a couple examples we'll walk through of maybe how you would screw it up and end up paying taxes, and then we'll talk about how to fix it. So on the left-hand side, we've got a really simple example. We sold this property for $1 million. We're 40% loan to value, so we pay off our $400,000 loan, and that leaves us with 600,000 of proceeds. And so maybe you found a building in town that's worth 1,250,000 and you know the bank well and you say, "Hey, I want to buy that building." And they say, "Great, we like the building. We'll actually leverage that at 60%. We'll give you a $750,000 loan." And so you do the math and you go, "Oh, awesome. Like I only have to put in 500K to buy this building." So you sold for 1 million, you replaced it with 1.25, so you think you're golden. But because you didn't put in all of your cash, in other words, you put five of the 600,000, this actually creates what's called cash boot for you. And this would be a taxable situation. Same example on the left-hand side, but let's just say, you know what, I'm done with debt. So I'm paying off this $400,000 note. I've got $600,000 in my pocket. I know I have to replace all of this cash, so I'm just going to go out and buy a $600,000 property. And of course, because you didn't get a loan and you didn't replace the full value of real estate, this is taxable as mortgage boot, forgiveness of debt. And this, even though you rolled over all of your cash, this would be taxable to you as well. So how do we fix it? So the first thing that you can do is to add leverage. So just kind of going back to that previous example where we didn't get any debt. Let's say you found a deal that was 55% LTV, or you found a DST, like through Origin, that was 55% LTV. You would roll over your cash, you would assume a loan of 733,000. And now remember I said you only have to do two things. Went up in real estate, so you sold for 1 million, and now you own 1.33, so that's a check. And then you replaced all of your cash. So you had 600,000 of proceeds. You have 600,000 of proceeds in the new deal. So this would be a tax-free exchange. The second thing you could do is to add cash. This actually is less known out there. Most people say you have to replace your mortgage debt. You do, but you don't have to replace it with more mortgage debt. So you can replace debt with cash. You cannot replace cash with debt, just like we showed in that first slide, how you had to pay taxes there. So same example, if you do have the cash and you don't want to be leveraged, you can find $1 million replacement property. You can roll over 600,000 from the qualified intermediary. You could wire 400,000 from a different source, totaling to 1 million. And you've gone from 40% LTV to 0% LTV. And this is actually a tax-free exchange for you as well. So you can add leverage or add cash. Those are sort of your two solutions. But I think at the end of the day, just remember that if you're working on a 1031, if I want to pay no taxes, I have to roll all of my equity and I have to replace the full value of what I sold. That's it. All right, so we talked a little bit earlier about a DST. So just to kind of focus on that, why do people like DSTs? How is it helpful in the structure? Well, when you do a 1031 exchange on your own, you're limited. So let's say you sell a property for 750,000 or 1.5 million or whatever you sell your property for, you have to find a property that's about that same price. You have to find a property that's for sale. You have to find a property that you like. You have to find a property that's geographically near you. You have to find a property that you can close on in 45 days where you kind of trust the seller. It's almost impossible. And so what a DST does is I kind of think about it as like a 1031 exchange in reverse. So picture a company like Origin, we go out and buy a $100 million apartment building in Dallas, Texas, or something like that. And we'll close on the property, we'll finance it, and then we will make it available to you as an investor. So when you sell for 4.3 million on March 1st, you could roll those proceeds into our DST on March 3rd and you would own 4.3% of this $100 million property. So now you've just exchanged up into a much higher quality institutional piece of real estate, and you've exchanged out of all of the day-to-day management, and we would just send you a monthly paycheck. So I know I did put the revenue ruling on there. So this is the highest level of guarantee that you can get from the IRS. We have a full revenue ruling that says an interest in a DST should qualify as like kind for the purposes of an exchange. So you can think of the DST as just a wrapper that owns a building, and that building is going to give you everything I mentioned before. So the main benefit is passive income, sort of cleaning it up for your family too. A lot of people that have owned real estate throughout the years is like, well, who's going to manage this when I'm gone? Is this going to be a burden to somebody? Nobody knows how to collect rent or appeal property taxes like I do. So who's going to run it? So by rolling it into something that's more passive and institutional, you could pass it on to your future generations with a fully stepped up cost basis and no burden of management. Plus, it's much more divisible. You know, bricks are hard to divide and people argue over who manages it and blah, blah, blah. When you own an institutional security, it's easily divisible and there's no management. So no arguing. It just kind of cleans everything up. Just to give you an idea of kind of the scope and nature of assets that we buy, these are some of the assets that are on our current portfolio. These are not DSTs that are available for sale right now, but these are the types of assets that Origin invests in our Income Plus fund, which we'll talk about in a little bit. And then I'll also mention some actual DSTs that we have in a second. Now, I mentioned we wanted to create a better mousetrap. And one of the challenges, if you were to go online and you were to look up DSTs, I want to invest in a DST, mostly what you're going to find is brokers. And the brokers are great. They're smart people, they know what they're talking about. But essentially, their entire business model is to help you roll into these DSTs, and they collect a commission for doing that. One of the things that we thought was sort of unfair about that is all of the fees in these DSTs are hidden in a 200-page prospectus, where if you don't read it, you wouldn't necessarily even know that they're there. Origin is a different company in that we don't work with any brokers. So you can come directly to us, and all of that front end load that's typically paid through a broker distribution network is cut out, which means you pay less in fees, you own more real estate, and that's going to lead to a better investment outcome for you overall in the very long term. And so, like, what are some of those fees? If you start paging through these PPMs, you'll see a selling commission that goes to that broker of 5 and 6%, managing broker dealer fees, sometimes up to a 4% disposition fee. Um, Significant. In some cases, egregious. Um, but you have to read it all to find out. And as I mentioned, we started as a family office, investing the capital of our two founders. And so, like, they would never put their money into something that had fees like this. And so we just cut them all out and we made it sort of an institutionally priced model. And so you won't see any selling commissions or dealer manager fees or disposition fees. All of that is cut out. We want to have a better investment return for you for the long run. And so that's sort of what we're offering. So in our DST model, if you were to kind of break this down with other companies out there, you just see very large numbers here. I don't want to go into what they do, but for us, we basically get reimbursed for what I call putting the deal together. So we have to talk to attorneys and put a PPM together and syndicate it and be on the road and talk about it. We charge a 1% fee, and that's called offering. O&O stands for organizational and offering. So that's our offering expense to sort of get the fee up off the ground, the deal off the ground. We pay no commissions. We don't work with brokers. We take nothing for putting the debt on the deal. We charge an asset management fee of 1.25% on an annual basis. And then when we sell the asset, we take no disposition fee at all. So very clean, neat structure that we hope the industry will model eventually. But you can come directly to Origin and do this deal with us. So here's just a couple examples of deals that we've had in the marketplace recently. This is the Starling. This is just north of Dallas. This is the first DST that we put into the market in 24. So $37 million capital raise. This one sort of flew off the shelf. It had sort of a special benefit to it where this property actually doesn't pay any taxes for the next 99 years. We have a 99-year tax abatement on the Starling. So this was a really powerful deal to kind of launch with. So that's the Starling. We have a couple deals that are very close to being sold out. I think Nashville, this one might be sold out as of today. but if not, it's got about $1 million left in it. This is in WeHo, so Wedgwood, Houston neighborhood of Nashville. And Nashville, if you've ever visited, it's very hilly. And so WeHo is sort of like an up and coming hot market. It's just south of downtown. And this is right on top of a hill. So you can kind of see there that rooftop. You could sort of see the umbrellas there. There's a little tequila bar up there and a U-shaped bar that sort of overlooks downtown Nashville. And then there's actually three buildings. They're just showing two of them there, but across the street is the third building, and it's got a parking garage, and above the parking garage is an actual band shell. So you've got the band, you've got the stage, the drums, the speakers. You've got like maybe a 10-foot bar with like a kegerator behind it. So residents can just sort of use that band shell at their convenience, and they host trivia nights up there. It's a really, really kind of cool property in Nashville. Next one is Charlotte. Noda's same thing. It's just the neighborhood is called Noda. This is a new delivery, 2023, Class A, stabilized. They're all about the same price. These are like $94 million assets. But these are sort of right in our backyard. As I mentioned, we've got offices in Nashville and Charlotte. So we know these properties really well. I think this one is 94% occupied. It's right on the light rail in Charlotte that sort of goes downtown. So I think you kind of get the picture that the deals that we have in the market are sort of going to be stabilized Class A multifamily assets. And when they sell out, they sell out. And then we'll move on to the next one. Like Charlotte, I think this one has about 3 million left. So we've got another deal in Orlando. I don't have a deal sheet up for it yet, but it's called Novel. You could actually Google it. If you just Google Novel Orlando DS apartments, it pops right up. You see it's a beautiful property right in the path of growth in Lake Nona, Orlando. So that's another 46 million of equity that we have coming out in the marketplace. So that's kind of a summary on how the 1031 exchange um, works through a DST structure. And for most companies, that's sort of where it ends. And the way the exit strategy for that traditional DST model is you go into a DST and then 5, 6, or 7 years later, it'll sell. And then you roll it into another DST. And then you roll it into another DST. And so that is kind of known as swap until you drop. And we had a couple challenges with that as an exit strategy. Number one, there's just a lot of fees. So I mentioned the fees of traditional DSTs. Every time you roll, you have to pay those fees over and over again. Number two, it's what we call idiosyncratic risk, single asset risk. So it's like owning IBM stock instead of owning a tech mutual fund. You'd rather be diversified. So it's a lot of eggs in one basket in a single asset, single asset, single asset. And then thirdly, it adds a little bit of operational risk to your portfolio. So 5 or 6 or 7 years later, that property will sell, and then you'll have another 45 days. Do I roll it into another DST? Do I like the DSTs that are available, et cetera? So with all of that, we kind of like this solution. We think it's a little bit more elegant and appropriate for our investors that are looking to simplify their life and pay less taxes. And that is to use a 721 UPREIT as your exit strategy to get out of that DST. So I'll talk about that. So 721 is section 721 of the tax code, and it essentially says if you sell a piece of real estate and you in exchange get an interest in a partnership, that is considered tax-free deferral in the eyes of the IRS. So, for example, if there was a big REIT, like let's say Equity Residential or something, and you had a $50 million apartment building that they wanted to buy, they could actually just buy that apartment building from you, give you $50 million of operating partnership units, and that would be a single stage 721. That's not what we do with our REIT because we don't want to buy all of our clients' assets, right? Farms in Iowa and apartments in Washington. And eventually, if we did that, we'd have this big portfolio of disparate assets. So the way our strategy works is that it's sort of a two-stage 721 exchange. So you can think about the first step in this 721 UPREIT process is what I just spent the first 20 minutes talking about, a normal 1031 exchange where you sell your property, money goes to a qualified intermediary, and then you would roll the proceeds from your sale into one of those DSTs that I mentioned earlier. You would actually stay in that DST for about 2 years. So during that 2 year period that's in the middle where it says DST replacement property, you would own an interest in that DST. So you would get a monthly income stream. You could write it off on your taxes through depreciation. You would get any appreciation to you if the asset goes up in value. You own it. Difference is, after 2 years, our Income Plus Fund, which is our big diversified flagship fund, has the right to acquire that asset from you. So instead of giving you cash, which would necessitate another 1031 exchange, we give you stock or operating partnership units in the company. And once that transaction occurs, that's a 721 UPREIT. And now you own an interest in a diversified portfolio of real estate rather than a single asset. So why a 721 exchange? You get that continued tax deferral. So 2 years in the DST, now you're in a diversified fund. You haven't paid any taxes. Consistent income, institutional management, and then it really cleans up your estate. So I mentioned this earlier, but passing it on to your beneficiaries, when they receive it, they could make a redemption and liquidate it and pay probably very little taxes because they'd have a stepped up cost basis. But it's very easily divisible to your estate with no burden of management. And then the biggest one is that you are diversified and you've sort of eliminated that idiosyncratic risk out of your portfolio. And you've also eliminated that operational risk of having to roll these deals every 5 or 6 years. So finally, I think just to kind of talk a little bit about the returns and expectations on doing a 721. One of our main thesis is that we think the best path to wealth is to stay invested into risk assets for the very long term without the frictional costs of like taxes and fees along the way. And so those can really erode wealth while you're not paying attention. And so, like our friend Charlie Munger was Warren Buffett's right-hand man for like 50 years at Berkshire Hathaway. He's got a lot of great quotes. This is one of my favorites. The first rule of compounding is to never interrupt it unnecessarily. Earn interest on interest and let things grow. And that's what this 721 exchange solution really does. So I actually made a little chart here that I think helps kind of understand how this process works. So just to talk about a couple things in this chart, there's three options here. Number one is I'm going to do a 1031 exchange swap until you drop. Just going to keep rolling it into DSTs over and over. Number two is I'm going to do a 1031 into a DST, and then I'm just going to stay in that 721 UPREIT for the long term. Number three is I'm going to pay taxes and I'm going to take the net proceeds after that sale and I'm just going to put it into a market portfolio. So typically we call that a 60/40. That just means 60% stocks, 40% bonds, and then you just earn what the market earns over time. So really what we're comparing here, you can see the red line pretty much never catches up because you have to make up that huge tax hit on the front end. But really what we're comparing is the gray line and the blue line. So if you were somebody that invested in the traditional swap until you drop, you'd actually be a pretty happy camper here because basically what you see is you invest on day one and 15 years later, your $1 million is worth about $3 million. But you'll notice every 5 years, there's this little dip. And that's basically just modeling in the front end load of those DSTs. And so that's what I mean by sort of eroding your wealth. And so with the 721, I modeled both of us having the same front end load, even though ours is lower. I just wanted to show what this would look like. So I modeled in a 10% front end load, even though ours is much lower than that. So here you take the hit, but then in the blue line, you just stay invested in a diversified portfolio that continues to grow, continues to generate income, continues to pay monthly so you can compound that return 12 times per year, and you just let the growth. Now, keep in mind, the gray bar and the blue bar are earning the exact same rate of return. They're both earning a 10% rate of return. The only difference is every 5 years on the gray bar, you're rolling it into another DST and paying a 10% load to get in that deal. And so that's just kind of showing you how that can erode your wealth over time. And then, of course, with paying taxes, you're almost 70% ahead by doing a 721 exchange because it's just very, very difficult to overcome that front end hit when we talk about kind of the present value of the real estate and the time value of money. So that's essentially how it works. So you've got the 1031 exchange, you've got all of those rules that you have to follow. It's very, very important that you get in touch with a very, very good qualified intermediary and advisors like attorneys and CPAs who have done these deals before. Once you roll into the DST, then you stay in there for about 2 years. After those 2 years, you're uprated into the diversified portfolio where you can stay for the longer term. So, kind of the next question is then like, okay, well, what does that diversified portfolio look like? And at least at origin, our fund is called the Income Plus Fund. So, Michael and Dave actually came up with this fund for their own capital because what happens in these ground up development deals is you invest into a ground up development deal, you build a property, and you get a nice multiple. So, you turn 1 million into 1.6 million or 1.7 million. But then the cash comes back to you and you have to pay taxes. And so say you pay 300,000 in taxes and now you roll the 1.2 or whatever's left back to us and say, let's do it again. So it's like 2 steps forward, 1 step back. So the idea was to create an evergreen vehicle where we could put all of our best ideas in the fund and it would operate into perpetuity. And so that we wouldn't have to continue to have tax drag. So you could redeem out of this fund if you choose to. If you don't, you could stay in this fund for perpetuity. So it's a diversified portfolio of multifamily real estate. We consider it an all-weather fund, and I think we just got it stress tested. So, people on this call are very familiar with commercial real estate. You know what we went through in the last 5 years with COVID, with the liquidity crisis, with the regional banks filing for bankruptcy, with labor costs, with interest rates spiking, with material costs. Like, it was one of the hardest times in commercial real estate for a good 24 months that we just went through. And the Income Plus Fund weathered that storm extremely well. So while we are focused on multifamily and high growth markets, we can also move the portfolio around. So if you think about early 2020, when we're just in the beginning stages of COVID and then interest rates get cut again, so you had cap rates that were in the threes, you had interest rates that were zero, properties were just extremely frothy and nothing penciled. So we just stopped buying properties and we sort of became lenders inside of this fund. We bought a lot of Fannie Mae K deals. We bought pref equity positions in development. So more debt-like instruments inside of the fund that really did well during a hard time. We didn't want to be equity owners when things were so frothy. So we managed this portfolio for the very long term. And it's really weathered the storm well. So, like I said, we call it the all-weather portfolio. Here's just a little graphic representation of everything that we've gone through from COVID to inflation, where the Fed started hiking rates. Silicon Valley Bank, that kind of flies under the radar because there was 3 banks that filed for bankruptcy all within 2 months of each other. And the volume of those banks filing for bankruptcy was more than all the banks in 2008 combined. It's about the same, but it was more. So it's really surprising because there's so much that went on that surprisingly kind of flies under the radar. But you could see that we turned your $250,000 investment to about 413, even going through this downturn. 95% of our months have been positive. So extremely good outperformance. And then we generate a nice tax efficient income stream. So remember, when you're talking about income, especially retirement income, it's not necessarily about what you make, it's about what you keep. And so, because real estate is a highly tax efficient vehicle, we're going to use depreciation to offset your income. And so, while we yield about a 6.5% distribution, you're keeping almost all of that through the tax sheltering of the depreciation that gets passed through to you as well. So, pretty powerful for people that are planning for retirement needs. You may or may not be familiar with some of the companies on this chart. These are sort of our institutional competitors in the real estate market. Some of them offer a 721 exchange, some of them do not. The point of this slide is just this is when real estate gets stress tested. And you could see on the trailing three, there's a lot of negative numbers there. If you were equity owner and you were buying in 21, 22, 23, those negative numbers are unavoidable. Interest rates blew up in your face, cap rates went up, values went down. So I think our ability to, 2 things. Number one, we're all multifamily, which is the best risk-adjusted return. And number two, that ability to sort of be flexible and change what we're investing in as the market changes has helped us really outperform the competition by quite a lot, double digits in a lot of cases. So we're really proud of that track record. This is just standard deviation in return. This is called a Sharpe ratio in the investment world. You're basically saying, how much return am I getting per unit of risk? Everybody knows that riskier investments return a higher rate, but how risky are they compared to the return that they get? And so that ratio is called the Sharpe ratio. And you want to have a higher return per unit of risk. And that's really why we like multifamily real estate. And you also think about it from a common sense perspective. When you go into economic downturns, multifamily occupancy tends to go up. It's a need, it's not a want. It's subsidized by Fannie and Freddie. There's just tons of reasons why we, for the very long term, want to stay in multifamily for the very long term to sort of preserve and protect original capital. So, to kind of summarize everything we talked about today, we offer a low fee 1031 exchange that puts more of your capital to work, less is gone in fees. You would roll that proceed into an institutional quality asset that would be managed by Origin, where we'd send you a monthly paycheck that exchanges you out of the day-to-day management and exchanges you up into institutional quality real estate. Of course, we have a multifamily focus, so you'd have no exposure to office buildings or data centers or shopping centers or warehouses or things like that, which is a nice like niche to be in. And then obviously there's that 721 UPREIT that gives you the diversified portfolio. So I think that's a good summary of everything we talked about today. And then I think we just had one more question. Alexandra, if you're on, maybe if you could put this last poll question up. And I don't think we'll share this result if that's possible. We just want to know if this was anything interesting to you. Would you like us to reach out and schedule a meeting? I'm going to share my information on the next slide, so you're obviously more than welcome to just email me directly or set up a call. But if you'd like us to reach out, we'd be happy to do that. So maybe give it a few more minutes. And again, Alexander, we won't share the results of this one.
Yeah, no problem. I'll just leave it up then in the meantime, and we can maybe get your information on the screen. If you want to go to the next slide, the poll will remain up. And then we did get a question as well. So as you all are thinking now about the presentation, if you could put your questions in the Q&A box, that would be great. And then we could maybe touch a few questions before we head out here. Oh, I love the QR code. That's very convenient. Thank you. All right, everyone. If you want to scan that QR code to book a call, it's yet another way to connect there, which is really convenient. That's awesome. Also, let me start with this first question here. Boris is asking, is your REIT 721 available via Fidelity?
Yeah, good question. So we do have a custodial relationship with Fidelity, so you can hold this investment in Fidelity and Schwab and Pershing and all of the major custodians. Yes.
Wonderful. So if you want to put your questions in, guys, you can do it in the Q&A. I'll give you a moment there. Just saw one pop up. David says, is there a minimum to invest in DSTs?
Yeah, good question. If you look at our materials, you'll see we have a stated minimum of 250,000. The reason I made it that minimum is I just want people to know it's a long-term investment, etc. But there's sometimes people have extra left over from an exchange and they want to roll 50 grand or so. Like we'll usually do it. So if you're below that minimum, email me, but that's our stated minimum is 250,000.
Yeah. And that does also bring up the other question, which I know we usually get is how long are these strategies built for, or what is the typical timeline? I know you covered that a little bit, but maybe that might help as well.
Yeah, and it's all about your personal preference. I mean, most people that own real estate that have built it throughout their life, they say, "Well, I'm just going to give this to my kids. I'm going to own this for the rest of my life."
Mm.
What's the downside to that? Well, I have to manage it, and then my kids maybe don't want it. It's look from real estate from the outside in looks like an easy job. Well, I go collect rent and that's it, you know. It's a very difficult job. And sometimes it's like, man, I don't want to burden people with this, so I'm just going to sell and pay taxes. So I think it depends on your financial situation, your liquidity needs, your risk tolerance, like what you're looking to do with your financial situation. But most of the people, they want to set it and forget it and just leave this in perpetuity. And of course, we do have redemptions available. So if you want to pull some out, that's taxable, but you can make the choice to redeem out of this fund down the road if you choose to.
Yeah, and I think that just is, it's clearly a long-term strategy. How long-term you want it to be will depend, of course. Andy says 6 to 7% return in DST seems to be low. How much appreciation can we expect?
On the DST side of it, you're buying very low cap rate, low returning relative to the market type of asset. So think brand new Amazon warehouses, brand new student housing facilities, et cetera. So they carry with them low cap rates. And so the returns on a DST are lower. Once you go into the Income Plus fund, you get the benefit of being in a more seasoned portfolio that can sort of move around. So Income Plus fund can do lending, it can do ground up development, it can do value add, it can do core. DSTs have sort of these handcuffs on them. It's called the seven deadly sins of a DST. You can't refinance the debt. You can't renegotiate loans. You can't hold on to cash. You have to distribute it. So when you think about owning a DST property, you can't add value to it. So you can't go down the risk return spectrum and knock down walls and fix it up. We would if we could. You have to pretty much own brand new stabilized assets. And so what does that mean? Return is a function of risk. So we're required to buy the least risky assets, which are lower yielding compared to the rest of the market, real estate market, but it's kind of like what pension funds buy. So you've got a very, very low risk deal. And then, of course, once you roll into the Income Plus fund, the return is increases for you.
Nice. Deborah says, how soon can you go into the Income Plus fund?
Well, to meet uh, it's 2 years. So there's a safe harbor requirement. So
Mhm.
that's why we have that sort of 2 year window where you go in the DST, and then after 2 years, you get uprated into the Income Plus fund. And we also do take cash investments. Like if that's just an interesting fund to you and you want monthly income, we close on the Income Plus fund on a monthly basis to just cash investors coming in there.
Nice. Byron says, are you basically a property manager that specializes in these types of transactions?
We don't actually do property management. We hire property managers. So you can think of us as a full service institutional real estate manager. So we raise capital, deploy capital. We have a full acquisitions team, finance, accounting, asset management. So the asset manager hires and fires our property managers. We're typically putting Greystar and the like to manage our deals. We've got about 75 employees across 5 offices, 4 billion of assets under management. So we do a lot more than just property management. The main, I guess, idea would be that we're portfolio managers. So we're doing the research on which markets should we be investing in, which asset classes, and then once we get there, which assets. And that's really where we shine, and that's why our returns have been so good.
That makes a lot of sense. And I think just thinking about it realistically, most of us can't necessarily go out on our own and invest in $100 million building. And so this is a way to be a part of that and do it through a company that has so much experience in it that you feel like you can hand that over a little bit. I know that's tough for some of you who have done a lot of your own DIY management for a long time. Byron says, thank you. This is interesting. Yeah, I thought so too. When Origin first reached out to us, I saw the Nashville property. We actually put that in our AAOA Today newsletter.
Oh, nice.
And I remember we talked about it a little bit, and I thought, Origin is doing something a little different than because we've all, like you said, we've all heard of the 1031 kind of thing by now, but this is different in that you're doing the whole thing from start to finish, and I think that really says a lot about the confidence you all have in the investments that you have in your portfolio as well, which is nice to see. I don't see any other questions coming through just yet, but I do encourage you to take advantage of this QR code and scan to book a call would be the fastest way to get in touch. with Michael here. And I'm so glad that you do offer time on your calendar. We also have, of course, the poll, but if you did say yes there, I'll also connect you with Michael in however you said you want to be connected or not. And then as you're exiting as well, if you could take the poll question, we can hopefully get a little bit more feedback as to what you thought about today's webinar. And then we have a webinar next week on Tuesday in exactly a week. I have a nonprofit coming on to speak to us. It is Human Trafficking Awareness Month. And so we're going to talk about how landlords are uniquely positioned to help in this cause and how you can get involved and even get a charitable tax donation. So please tune in for that. Check out your emails tomorrow for the recording and the slides and Michael's information one more time. Michael, thank you so much. You really went through such great examples, and I think you're very clearly spoken here on exactly how it all works. So looking forward to working with you in the future.
Great. Thank you so much. Appreciate it.
All right, everyone, take care. Bye.
Bye.